Hello guys, in this special video we're going to cover up a very large and hard to define topic, but yet very interesting though. So this is the ETF problem. So this is something that most of the perma-bear traders will have to talk to you about. They'll obviously have talked already about that a lot. Probably. The thing is that generally the difference between a trader and a perma-bear is that the trader will pick up some very few elements that show some very high risk profile, at least high risk enough to trigger some probabilities to profit from this. In opposition from the perma-bear that will basically just sum up all the things that are not right and tell you this is not normal, this is not normal, this is not normal, this is not normal, and the entire pile of shit that is abnormal suggests the market should go down. I mean, that's the perma-bear perspective. They're telling and that too many things are not right, and then that the price should go reverse because of this. This is a big difference because my approach is totally different. I'm not telling you that things are dirty and that this is what will cause the market to crash. All I'm telling you is that things are dirty every time, but at some time we take too much risks, and that risks increasing shows some very high probability to see profitability out of those scenarios failing. And sorry about that. And in that perspective, what I generally search for is a very specific thing, that is a parabolic scenario. As you know about my crashing market pattern in which the prices go parabolic and the risk is increasing parabolically as well. And all those paraboles always end the same way, in a very brutal sharp reversal that the market is then collapsing and switching from bullish to bearish instantly. So this pattern is basically what we're going to trigger, but in some specific assets that are correlated to the stock market. So these are the reasons why I've been calling them risk factors, because these are sectors having some parabolic ascension, showing some systemic risks, the fact that it's using some kind of parabolic pyramid schemes or things like that. And those assets specifically and linked to the US market shows very dangerous states of advancement. So we're going to talk about those, and these are two specific things. The first one is what I've been calling the repo market, and I've been making a video about this one. You can search between the educational content right in the YouTube channel. You have one that is called, I don't remember the date of that. It wasn't a daily forecast. We made a daily forecast and we just talked about that specific problem, that is the repo market. And that is a systematic problem. This is basically the credit bubble risk problem, in which we are piling up credit every day and every day and every day and every day on a day-to-day basis. And at some point, that credit bubble is going to burst, and it's going to burst the liquidity that the market needs to operate in a daily basis. And the repo market is short-term lending market, which is like the oil into the engine of the car going really fast. So that oil must be really efficient, and lacking of that oil is probably going to force the engine to burst and to explode. And this is what basically is one of the biggest dangers for the market right now, the repo market getting out of just getting off. If this market is off because of too high rates and short-term rates, no one's going to lend that money to speculate, and we have no bullish speculators. We'll basically have nothing else than just long-term sellers, and that will cause the market to be a selling mode only without buyer, and this is the most dangerous thing when you are trading historical highs. So that was the other asset risky things. Just to consider this as an introduction. It's just to make sure that you're not going to pull me right into the perma-bear things because I'm talking about things that are not doing well in the market. I don't really give a shit. The markets are not meant to be rational. It's just that the market at some point is going too far into shit piling. And some shit might be piled upon each other forever. They're not problematic. Those who cause us big problems is when you have a pyramid scheme, parabolic systems. These things are meant to end pretty nasty and without giving pre-signals. This is what we care about. And we have another sector right from aside from the short-term lending, that is the repo market, we have something that has been taking place on a much longer time frame, which is ETF volume piling up. And we're going to talk about this one. So this is what you have in front of you here, is the SPX 500, and this is that green line is basically the ETFs amount. So what I've been taking, because we're going to do it straightforward, I'm not going to hide anything, I'm just going to show you how I've been creating this indicator. I've been creating ETF supply and demand. So what we've been using is that index AVVE, DVCE, and UVCE, who are basically buying volume of ETF, selling volume of ETF, and maintaining volume of ETFs. And what I've been doing is adding maintaining volume with the bullish volume reduced by the downward volume. So it basically shows the volume of the ETF markets piling up on top of each and every day. I mean, the more day we have, we generally have more buyers than sellers into that market, plus the sustained position, which means this is the exact amount of volume we have into the ETF market. And as you can see, this is supporting the stock market. It's exactly the same. That's this is what's beautiful in here. It means that right here, as long as the market is piling up, we can see the ETF market has been following that move. But once again, what's important in there is not to just figure this out. This might make sense. This is normal. Since the latest bottom, we've been following things, but at some point you can see ETF market is just overperforming the stock market. This is what we call a decorrelation. And at that point, this is where things start to be a little bit dangerous. Means that ETF is known to be the perfect retail traders, or at least low capitalized trader investment vehicle. They're getting in there to get return out of passive trading, which means professional traders are doing stock picking at the end of trends. They know the trend is going to range for a bit because professional traders are getting into stocks that have short-term potential and getting out of stocks that have been taken out the entire long-term perspectives, which means they're taking the money out of a long-term trends, but still stock picking in a short-term trend. All right, this is what maintains the price in a range. This is basically what's been going on in here. Long-term money getting out, short-term money trying to find some value at short-term trends. It's basically stock picking, getting out, stock picking, getting out. That's basically it. They're just buying things to take the latest bites out of a dead animal. All right, we know it's dead. Otherwise, we wouldn't sell long-term trends. We're already selling those. And just to set things straight, we're really doing. I mean, institutional tradings right now have a negative volume on the equity market. They're just pulling out. Yet the trend is still ongoing. So who the hell is getting that trend to the upside? Either we got the retail traders buying and ETF buying as well, which suggests both ways are the worst possible ways to have retail traders buying, ETF supporting the volume, and long-term investors, professional investors pulling out. This is generally what we call a long-term reversal. But anyway, like usual, we see no one seeing this coming. Everyone knows it's going to end not end well, but everyone doesn't want to be the first one to tell it. So I'm here to tell you, things will not be great, first, and secondly, we've been piling some very dangerous parabolic schemes in here. First, the repo market, and secondly, we've got the ETF. We're just going to unwind this so you see what's behind the surface in here. So first thing first, we see the decorrelation thing. Things that anytime the market went parabolic, it was because the volume was over-supported by ETF holders, which are known to be very dangerous holders. So now we see that we're not just going to take that as granted. We're going to move on and explain why. So we're going to move on to what happens when things get dirty in terms of stock markets. Okay, so now that we're here, look at this. So we're going to just pile things again. We're just going to resume this first of all. Sorry about that. So I'm going to do this. All right. So we're going to try once again fine-tuning. Okay, as you can see, we're trying to fine-tuning. In here, once again, before the trend reversed, overvalued ETF demand over the stock market itself, and then things change. ETF volume is pulling out, the market is peaking, and then brutally reversing. But what you need to care of in here is the volume that is going down. In terms of value in here, volume back then was 23,000 and it dropped down to literally basically near zero, which means negative volume in the ETF market. Now let's go there and let's see what happens. Basically in terms of cycles, okay, if you're considering this as cycles, because remember, when you're trying to assess correlations, you don't want to compare two things that are not comparable. You need to see those correlations. You can clearly see those things are moving together. The thing is that they're having a lot difference in terms of strength. Okay, same bullish cycle, but as you can see, when things get dirty into the stock market, and basically right in here, all the perma bears were just, the world is about to end, the stock market is going to crash, and that's normal. We told you that would come, and now it is. We were right, and you were wrong to buy. Fuck it, they were just wrong to tell you to sell. You had to buy those low for simple reasons. After a growth market, you always have a consolidation that you need to buy, and that's the latest movement that comes after that you need to sell. So this is the movement that you need to sell long term, not there. This was just short-term pullback, and as you can see, the stock market has just retraced barely 23% back then. Okay, look at this. Been pulling down to the bottom, up to the top. We've been retracing less than them 33%. We've been 23.6%, not even reached out to 38.2, which means barely nothing in terms of retracement. We've been surrendering less than 25% of the gains we've been making throughout the bullish cluster market. Okay. At the same time, the ETF levels went back to zero. Okay, the initial point. Which means right in here, at the bottom of ETF, if you're using another Fibonacci retracement tool, from bottom to top of the volume in here, we've been retracing 76.4%. So you can compare 25 average percent losses into a stock market retracement and 75% downward move on the correlated or supposedly correlated ETF market, which says just one thing: when things get wrong into ETF, it causes market pullbacks, but the volume into ETF is dangerously falling apart when things get dirty into the stock market. And as you can see in here, things weren't really going dirty, but those who were holding ETF just went to panic as they've been losing most of their money. Okay, so the volume is peaking out. They were selling and they were saying, fuck, I want out. I want to sell this shit. I don't want that anymore. This is basically what's about to happen next. So one step forward from now, if you're just comparing those two once again into long-term trends, what we're having right now is an unwinding market. Market is going up, but the ETF market isn't following this. The prices have already started to break down support, which is dangerous, which means the ETF money is at risk. And whenever it will wind down, it will take the stock market with it, which means I don't think we're going to have a parabolic move on the SPX. More likely going to have a peaking move on the ETF market, just like we had back then. We're basically doing this at the moment. Everyone thinks that we're going to go up forever and that we'll have forever volume entering the market. I think anyway we're nearly reaching the end of the ongoing inside volume, but probably going to have an outwinding volume going out of the market, and it's not going to be pretty, because anytime it's going to happen, the market will just range a bit before not wanting to surrender the gain, but we're lacking the gas to go further. And when a market lacks of volume, it generally reverses, which means what we had in here was the end of a wave 3, okay, which means the end of the growth wave, in where no fucking damn perma-bear arguments is standing in there. Everyone is telling you, okay, fuck it, the Fed is putting money out there, it's gonna blow up, don't buy the stock market. Fuck em, you just buy the dips. This is where you buy the dip, no questions asked. This is the growth wave, in where money is free and you just wanna just grab it. I mean, the money's free, damn, take it. What the hell were the arguments to sell back then? There was not a single argument to sell. It was just buy the damn dip and shut the fuck up. Okay, so perma bears, big losers in here, as there was just free money. Now perma bears are probably right, but once again, whenever you say something's not right, everybody is always already putting you into the box with others who are just saying bullshit all way long. I wasn't the kind of guy who just told you to sell for years, just the kind of guy who tells you that right in here, things started to get a little bit weirder, and now we're pretty much down into it, and we're going to have to pay for it. So what we're doing right here will entirely be retraced, which means those prices, we're going to price those again, for sure. There's no certainty, once again, but 99% probability to get those price agains. So, do you really want to buy those as you could buy those? I personally would have to wait to get those to buy again. So buying in here is for stupid traders that don't want to wait and will be ready to buy very, very stupid prices. So that's up to them, and just let them buy those stupid prices. If they want to buy thinking that they can make easy gains, okay, then they can eventually do it short term. If they are holding those trades, and most of those will, they will lose a lot of money. But they don't know it yet. That's how it is. I mean, only professionals know how this is, how knows. And we don't know, but we'll speculate. And for now, risk-reward is to the downside, so I wouldn't necessarily bet on a necessarily right now downside move, but I think anyway the next move is to the downside, no matter what. And in perma bulls, those who are making the biggest mistakes right now are those who are trading this as a trend, as it's not. I mean, we're not in a trend anymore. If we just use with strategy, for example, we're wave 1, 2, 3, 4, 5, and that's the best case scenario, which means we're being to the final wave of a final multi-year trending. Which means, anyway, if we still go upward, well, don't have much of a gas. Sellers are already at play, and the next move is going to be bearish retracement of the 8 years growing market. Okay? And just to set things straight, if we just retrace 23% of that movement in here, just get us right here, and I think that's the first price we're going to get to, and right in this already is nasty for bull guys. Those who are buying right now, they might not be able to handle such pullback, knowing that we'll probably get to retrace at least 38.2% and probably a little bit deeper. So these are the price you want to eventually consider start buying on if things are still doing well. Probably buying between 38.2 and 50% retracement. So this is the long-term buying area. Do you really want to buy at those prices, which are nearly quite the double as what you could get? No, you don't want to buy high pricings. You want to buy low and sell high. So this is why the guys are selling right now. So moving on to the daily chart. As you can see, the volume in ETFs is just slightly dangerous right now. So we might have something dangerous, the fact that we've been breaking supports in terms of ETF volume going out. So people are asking out, and they're starting to do it. Right now they're buying again, meaning that the volume getting inside is stronger than the volume getting outside. This is what drives the price higher into ETF demand. And as we've seen recently, we've got strong bullish demand out of ETFs. Okay? And the volume is supporting the price. So who the hell is buying right now? ETF traders. Money's getting in, price is moving up. But these are not smart traders. Remember, ETF is dumb traders buying in by using compiled vehicles to get in there. Just now we're going to make the comparison. What the problem is with this. First, because the volumes are getting parabolic into the ETF market, which means more and more demand. So shows us and tells us one thing, that the dumb investors are trading more and more. And the more they trade, generally the more we reach out the end of a trend, which means generally when people get caught interest into markets, it's generally because we're nearing the end of a trend and that the smart money is winding down and getting out as the people are getting in and buying very uninteresting prices, thinking that this will go on forever. So having the retail traders trading more and more since the latest 2 years is not a good sign, and the fact that recently on the latest few weeks we had a pretty damn uptick into the demand volume on the bullish supply of ETFs. Okay, so people are getting in without knowledge of the market, with probably dangerous leverage, as most of the big problem with ETF is that you have leverage into ETF that you don't have when you just buy a stock. Okay, when you buy a stock, you can buy 10 stocks if you have the money to pay for those. But if you don't, you cannot buy 100 stocks if you can just afford 10. The thing is that when you do this, you cannot invest with leverage, and leverage is only multiplying emotions, okay? It's getting emotions to be deeper and more dangerous. The thing is, people are now a lot into ETFs, thinking that they are safe vehicles, not knowing that these assets are dangerous derivatives. We're nothing close to trading the market when you do trade ETF. First of all, somebody sold you that ETF, and you'll have to sell it to someone else. But you're not owning stocks and nothing close to it. What you're owning is a damn ETF, which is a derivative contract, which means you better have liquidity to sell that at good pricings, otherwise it will be problematic to you. And moreover, if the stock market is falling, if you took leveraged ETF, you're gonna get stopped out because of not enough margin, which means if your ETF worth damn zero at value because you've been multiplying the market movers with that ETF is a tracker. Consider it that way. You're using a tracker to track the market moves. As long as they go up and the volume demand is good, then that's good. The stocks are bought and not sold. But anytime these things will go opposite side, the people want to wind out of the ETFs. How the hell do you think this will go? The stock market will go down, the losses will multiply with those who've been using leverage, and this will go wrong. This is how it is. And this is how it will work. It's just a matter of time, just don't know when. And once again, I'm no magician. I don't do timing. All I do is risk managing. And from now on, if you're down invested into ETF, you better wind down before the price goes down, because you know how it's going to go. When we were retracing just 23.6 damn percent, the ETF volume has been winding down to its original level, back in the opposite, back at where it was at the entry and the beginning of that bullish wave impulse. So the lesson in here is that whenever the prices wind down, ETF value is generally divided more than the stock market. So if you're thinking that you're making nice gain just following the market, then great, this is what you do when the market is bullish. Now you'll see pretty soon what happens when the market is bearish, and you're not going to like it. So the only suggestion I can tell you right here is that you may not want to sell all your ETFs. But if you do have invested into many different ETFs, or having most of your capital invested throughout ETF, you might want to spread the risks and not putting everything in there, because that is great danger to me. Just like the VIX is another big problem, and volatility covers and buying puts right now might be dangerous, because those who are selling those puts at very cheap prices might not be able to pay for that insurance at some point. So we're going to take that discussion in another video, but that's the final risk. I got 3 risk factors right now. We've got ETF investment that suggests retail traders are at play right now and increasing their leverage into the market. And that's not a good sign at all. Second signal is that we have the repo market that makes the short-term professional speculators at risk of losing money at some point if they keep on speculating, because the money is going to cost more each and every day. At some point, it's not going to be supporting the risk taking anymore, which means they'll just wind out the market and stop speculating short-term moves, probably meaning that the intraday liquidity will just fall apart. And as long as we'll have lower volumes at higher prices, means the end will be near. So this is something that can end the market in just a few days by just flushing out all the intraday volume. So this is the risk regarding the repo market: lacking of volume, lacking of liquidity, and triggering the credit bubble in the end. Second problem, ETF investment, suggesting that the retail traders are at play right now at very, very fucking expensive prices and generally not ending well. And the last and final risks is the one we are about to talk about in a future video. Is going to be the VIX liquidity. We have a very low liquid VIX. Already aware, even the CBOE itself have been saying that the low liquidity of CBO contracts on the VIX futures contracts were very concerning, and the fact that we had traders speculating heavily on selling volatility, not necessarily knowing if they will be about to pay for this, which means they are short selling the volatility, but if things weren't to get dirty, they probably won't be able to pay for the future contracts, even though the futures market is pricing accordingly to those short entries, which means guys are forecasting that things will do well, but if things don't do well, they might not be able to pay for it. So ask yourself a problem, ask yourself a question, is this normal, or is this going to be a problem at some point? I think that this is going to be a problem. We've got increasing volume into the VIX, but this is just the headline. I'm just going to dig a lot deeper into this pattern pretty soon enough when we'll make that video. So consider today as just an introduction to the next forthcoming video regarding the three major damn risks we have. Both are parabolic risk, okay? Because what you have in here is showing parabolic bullish demand. As you can see right here, we're going to zoom out and just look at this. Don't you see the parabolic demand? Got this wave, and this wave is crazy higher than the previous one, as this one is just the same shape as the previous one. So we've got crazy parabolic demand in here, and the fact is that anytime we reach out crazy high demand, so this is the final indication. We're going to terminate in this. As you can see, just going to look at this. This is really stunning. So what we have in here is another indicator I've been creating. This one is a little bit different. I'm going to show you what this is about. This one is basically this is the formula. Okay, I'm studying the change of the previous, studying the change before the 14 bar before, which is basically what we call the ROC, rate of change. Okay, so it's basically the change between what we have right here and the price we had 14 bars before. So it's pure momentum, studying how much we went higher or lower than the 14 previous bar. And I'm assessing this, creating an oscillator of the difference between the rate of change of this regarding the rate of change of the underlying broad-based index, which is the SPX we have right here. So basically what I'm doing in here is showing the comparison in terms of momentum between this, and this creates an oscillator in here, and this is what is great fucking danger in here, is that if you do this, if you just put horizontal lines, you'll see that anytime we get above those level or below those level, first you take a low, and then you take a market top. Every time, market top, market top, market top, market top, market top, and market top, and probably a market top in here as well, or a market top to come. So it's either we're going to make one more push and we're going to have a market top pretty soon, but right in here we're in positive momentum, which means ETF money is getting in. I've been putting the zero value in here. When the oscillator in here is positive, means ETF volume is supporting prices. Okay, when you have negative value, means ETF volume is underperforming the SPX, which means ETF money is pulling out. And as you can see, every fucking time the market is going down, the volume, the ETF is pulling away pretty damn solidly, which means in here we're in a cycle, and we'll see about that. If we made a market top in here, then big danger out on the world, because anytime this will get to negative value means that the ETF volume will no longer support the equity pricings, which means we're going to get probably to the big short entry. So we're on a daily chart, which means it can take a long time. I mean, if we're about to make another bullish move, probably going to be a long-term, not long-term, but a long move, just like it was back then. We would be there, for example, and we would probably be about to do just this, a big thing before we get to negative value. So probably an extended 2 to 3 months, leaving us to the end of that year, probably about around October or September, end of September, beginning of October. And I think generally that timing is the worst for equities. I mean, generally October, you've got, for example, the 1987 crash, right, in October, 19th of October, to be honest. That's the day I've been born. I mean, I'm basically born the day of a biggest ever market crash. So that's just for the story. So now you guys know when I'm born, and I'm basically born the day the fucking market just fell apart. So we'll see about if I'm right. But generally, in terms of seasonality, October is one of the biggest danger month, and we'll see if the market survives until then. And if it does, I think near October we might have some timing to get into searching for the big short, following that scenario. So have a look at this and watch out this very closely. Whenever we'll get to having that indicator into negative value and having the market in here picking up will be the time to get into searching for long-term short entries. I'm not talking about short-term. I'm not talking about getting there and retracing back to support. I'm talking about crashing market because we're having a credit bubble. Okay, clearly we're having a credit bubble, and the credit bubble is generally retracing price to at least 30% retracement, which is the minimum, and generally we're going to have to go a slightly lower. And as I've been saying, I think we're going to get back to those long-term levels. At least those one will be the minimum, which is 38.2% retracement. All right, so that being said, I'm going to leave you guys in there. I hope you learned quite interesting things regarding the ETF big danger down we have down the road. It leaves us with two possible options, I think, right now. It's either we're going to fail making new highs in terms of demand for ETF, and then we're going to wind down, have that oscillator crossing down, and then the problems will be there earlier than expected. Option number two, things are doing well. We have no damn problem. ETF volume is making new highs. We're going to probably have a surge into ETF demand, which means expecting this, if this is a parabolic move, going parabolic and creating another crazy high demand on ETF, it's probably that retail traders will expose themselves to ETF, taking crazy demand for leveraged ETF and things like that, to get into putting more and more money and moreover money they don't have into the stock market. Whenever this will happen, you know the dirty part will come right after pretty soon. It's a matter of month. Right now I can give a timing, not a precise timing. I don't know, it could be tomorrow, but I think that option number one, if we just fail right in here, it's not going to take more than a couple weeks. I mean, we will be right there in a couple weeks into danger area if the market is already about to collapse. Second option, we buy ourselves sometimes, and in that case, the ETF volume will probably be the big supporter of prices in the next following weeks and months, and it's probably going to save us another additional quarter. So probably going to lead us toward end of September, October, for example, and whenever we get to Q3 earnings release, I think nasty things will be at play, and that's the moment basically we're going to figure out that retail traders are buying fucking shit that is not going to make profits anymore, and we're going to have to wind down the price, and that's not going to be pretty, because prices will move down pretty fast with no one to buy, and retail traders wanting to have their money in a market with no one buying. That's basically it. Think it the way it is. Smart money is winding down, not for a damn reason or dumb reason, simply because they know the risks are there, not getting the money in the end when they will ask for it. As you, stupid traders or retail traders, I'm sorry, I'm not meant to insult you, but you are guys who don't know how the market works. You think you know how it works, but you don't. And there is a thing that you haven't thought about, is the liquidity problem. You're thinking that forever when you're trying to sell, you'll get someone to buy. You haven't tested a bearish market first. Okay, whenever you test it, as I said, you're not going to like it because you want to try to wind down, to go out, but you're not going to get the prices you wanted. You're going to ask for someone to buy at that price. It's not going to buy at that price. It's going to buy you 1% lower, and it's a give or take. It's how it is. I mean, at that point, you just want to go out at any price, and believe me, the price will drop damn fast. Because if no one wants to buy and everyone wants to sell, you know how it goes. And use that. We generally use that image that the market is getting up using the stairs and going down using the elevator. So that's how it is. I mean, we're going to have very few available liquidity to buy the market with a lot of selling demand, and that's what we call. We can compare this, as I said, you're climbing a 50 damn stairs, a 50 floor building with the stairs. You're getting to the top, exhausted. And guess what? The smart money is getting out already, and they're using the elevator to get you down. So that's how it is. I mean, it's not going to be pretty for those who are buying right now, unless they're doing it in a very short-term perspective. All right? So be assessing that risk. Once again, I'm not there to scare you out and tell you that you should get out right now. Just telling you that if you've been putting too much money in there, just be aware that you should spread the risk right now, as the smart money has already done that. Doesn't say that it's going to collapse right now. I'm not even saying that the market will just go crazy overperforming the next following month. All I'm saying is that if you play that game, don't forget to get out before it bursts, because when it bursts, you're not going to be able to get out. All right? So bye guys, be really, really cautious, and always have a look at this. I've been giving you the formula. Just put the damn formula into your charts and put an alert on it. Anytime this will break down the previous lows, this will mean a crazy high danger for that market, and you don't want to remain a long-term buyer on those when the red flag will just pull out. Bye guys, and see you in future videos.